Okay, here we go. Good afternoon, everybody, and welcome to Reverse Mortgages, one of my favorite, especially with Kelly. I'm Cindy Bishop with Cindy Bishop Worldwide, for those of you who don't know it, and would like to introduce our master instructor, Kelly Katalinas, today. For those of you that don't already know Kelly, she has been in the mortgage business for over 30 years. See, now that we're getting older, we say over 30. We don't give exact, times anymore. During that time, she's become a consistently successful lender and branch manager, leading her teams to success as an effective trainer. She's also a very effective trainer for agents, helping them improve production and creative lead generation cultivation. With this educational approach and exemplary business reputation, she has been the recipient of the Best Lender Professional Award by the Washingtonian Magazine, among other rewards she received, plus the one that she received now again, the 5-Star Professional Award. And that is really validated by peers and by customer reviews. There's quite an evaluation that goes into that. So we're very proud to have Kelly. She's just a superstar. Kelly is loved by her clients and agents, which is proven in the fact that more than 95% of her business is referrals. Kelly comes to us today at the topic of reverse mortgages. Welcome, Kelly.
Hi, everybody. I'm so glad to be with you today. Thank you, Cindy, as always, for the very kind words. I love talking about this topic. Fairway is a big reverse mortgage lender. And as we have a lot of population in the baby boomer generation that may be downsizing or looking to retire, the reverse mortgages are a lot different than how they used to be and are really very valuable if you integrate them into your retirement planning strategy. So we're going to uncover reverse mortgages a little bit differently. I like to approach this training as though I were the consumer, which I'm not far off of 62 personally. And, if I were doing this, what would be most valuable to consider? Because the reverse is not just for someone who owns a home right now and wants to access that equity. It's for those people that might want to look at a reverse for purchasing a new home as they look to move to their last purchase or retirement home or whatever, and perhaps not use all of the equity out of the sale of the current home, but strategize in using that equity to stretch assets over the course of retirement. So we're going to cover a lot of topics today. Our group is not that large. You can unmute if you have a question or throw it in the chat. We're going to try to monitor that as we go. But typically, if you have a question, most will as well, and I'll try to answer them as we go. So we're going to introduce what a reverse mortgage is, and we affectionately call it a retirement mortgage. We like that better because we do see it as a retirement strategy. There are some loan qualifications that play into a reverse mortgage, not in the typical sense, but we'll go through that and options for reverse, how you can use it. And this is the greatest. I get very excited about how you can use a reverse mortgage because there's nothing like this anywhere. It's really, really versatile. Loan maturity, and of course, why Fairway. And that pretty much we're one of the top lenders in reverse mortgages across the country. So let's go through. I can ask this question of probably every real estate agent I've worked with: what is your opinion of reverse mortgages? And we'll hear these two answers. We'll hear somebody who is aware of them and understands the versatility of the product say they're great. And then we'll hear somebody on this side say, I've heard some bad things about them. I need to learn more. Or no, don't discuss this with me. I've worked my whole life to pay my house off. I don't want to hear about something in reverse. Well, you may be missing out on a very, very powerful financial tool for you. And we're going to go through that. So if you're 62 or older and you're concerned about the following, right? Market volatility, inflation, the value of your dollar in retirement is worth less than you had planned for. You're concerned about outliving your savings, okay? Making monthly mortgage payments in retirement when income perhaps is diminished. And that lends into deferring the age at which you choose to retire as a result, okay? And then not being able to continue to live in your home in a safe and sustainable way, or as we say, age in place effectively. Okay, so a reverse mortgage could be a solution for this, and we're going to go through. So what is it? Okay, it is a home loan that is exclusively for older adults aged 62 or older. It takes a percentage of your home equity and converts it into tax-free cash, and we're going to go over that. Okay. There's no required principal and interest mortgage payments. You have to still continue to make your property charges like your real estate taxes and your homeowner's insurance. That's not negotiable. You're taking care of that yourself, but there are no required principal and interest payments for the loan portion. So the most popular type of reverse mortgage, the one that is used almost 95% of the time across the US, is the Home Equity Conversion Mortgage Program. It's a HECM. It was launched in 1989. It has way more amendments and protections to the consumer since its inception in 1989. It is the most used reverse mortgage in the US, as I stated. It's the only reverse mortgage insured by the Federal Housing Authority. And mortgage insurance in this case is a really good thing. And I'll explain why, okay? And then again, exclusively for those 62 or older. So aren't reverse mortgages just the loan of last resort? And many people looked at a reverse mortgage as saying, I've suddenly taken ill. I now have greater expenses. I don't know where the money's going to come from to take, to take care of my ailing health. I'm going to look to a reverse mortgage. I don't want to do it. It goes against everything I believed in. I want to leave my children an asset, et cetera, et cetera. So a lot of people perceive this loan as a loan of last resort, and it is not that, okay? It's got wide appeal. Affluent adults use it. People like us who are on commissions use this as a very powerful financial tool, and I'll explain that as well. So primary reasons to get a reverse mortgage: need, right? You might have an urgent need, like paying for in-home care, right? Suddenly a medical situation has arisen and you need to access some assets. Maybe it's lifestyle enhancement. You want to pay for things not in the budget, right? You want to travel, you want to do different things. Maybe you want to ease into retirement and you don't want to deplete particular accounts that are actually doing really well for you, and there would be a tax consequence for doing that. Maybe it's for lifestyle enhancement or financial planning. And this is the big piece of it, right? Everybody should be talking to their financial planners about what a reverse mortgage can mean in saving for retirement and utilizing current saved assets for retirement and utilizing the home equity in the current house that they want to live in retirement. So pros and cons, right? On the pro side, it is an additional source of income, right? It's cash flow. And there's many ways you can take that cash as far as using the equity in the property. You have no monthly mortgage payments on principal and interest. You do, again, have to still pay the taxes and insurance and maintain the home. And it's a non-recourse loan, meaning no one is going to come and take your home away from you. And I'll explain that further as we go through. There are a lot of people like, oh, they're just going to come and foreclose on you. That is not how a reverse mortgage works. And that's why mortgage insurance is very important. Cons, there's a minimum age requirement, right? It's not for everybody. It's for those age 62 or older. There are interest and fees chip away at the home equity. So just like in a forward mortgage that I've done my entire career, you have principal and interest calculations that you must pay to reduce your equity over time. Well, in a reverse, that gets tacked on to the balance each month. Okay, so it's reverse. It's adding over time. And it has to be your primary residence. It cannot be done on investment property. It can't be done on second homes. Remember, the underlying program is an FHA program that is owner occupied only, primary residence. But there are some myths that we're going to debunk here, right? Myth one, the bank will own my home. You own your home, you are entitled, as long as you meet the loan terms, there's nobody that owns your home but you. It's just like any other mortgage in that respect. Okay. Myth 2, I must own my home free and clear to qualify for a reverse. Again, not true. You have to have sufficient equity. It's not designed for someone with minimal equity in the property. You can pay off the existing mortgages at closing using loan proceeds from a reverse. So if you have somebody who, let's say, has, an $800,000 property with a $100,000 remaining balance, and they want to now refinance to a reverse mortgage, they would pay off that $100,000 forward mortgage and add it into the reverse limits that they're allowed to, okay, and not have a mortgage payment. So there are things you can do there. Myth, my heirs will be stuck with a big bill. You or your heirs will never owe more than the value of the home after the loan matures and the home is sold. Okay, so that's really important. So let's talk about the 3 buckets of wealth, and we're going to break this down. We're going to define them first, then we're going to break them down into the traditional mindset and then in the HECM reverse mindset. Okay, so right now you have, when you're starting your working and you're 18 years old to 62 years old, you have your pre-retirement wallet, and you have 3 buckets, right? The first bucket is what do you earn? Your wages, your commissions, your pensions, Social Security. What can you count on that's coming in since you started working, right? Then bucket 2 is your savings, and that's typically 5 to 20% saved for retirement. That's your nest egg, right? It could be your 401k, your IRAs, lump sum savings, life insurance, annuities, whatever you have set aside in that second bucket as your nest egg rainy day fund, right? Then you've got the home equity, right? Bucket 3, it's what is the equity in your current property, right? Your down payments and everything goes into that calculation, the appreciable value of the home as it stands right now compared to what you owe on it, all right? So in the traditional thinking, this was your retirement cash flow strategy prior to the reverse mortgage coming into play, right? You have bucket 1, monthly income. Well, your earned income decreases if you intend to retire at 62 years or older, unless you've set up massive amounts of passive income, okay? You might see a reduction in your monthly income as you retire. Bucket 2, that stays the same. That's your supplemental income, right? So in the first bucket, you might have your Social Security, your pensions, any annuities you've set up that are going to pay you on a monthly basis. And then in bucket 2, that's your supplemental, right? That's your lump sum, that you might need for any emergencies or what it's earmarked for something, or just savings for retirement. Okay. And again, in home equity, your real estate home equity, it largely was ignored, right? You find that you're in a home, it's got a ton of equity, it's sitting there, it's not working for you unless you sell that property. If you take out a standard home equity loan, you have payments on it. If you take out a HECM reverse mortgage, you have no payments on it and still have access to the equity, okay? And you just have to kind of think about managing the balance. So the home equity is largely ignored in the traditional mindset. If we move it to a new way of thinking, right? The first and second buckets remain the same, but in bucket 3, you're leveraging that home equity without making monthly mortgage payments. And the tax-free cash flow is a buffer asset to you, okay? So a couple of things ring true here as I discuss this. So think about how Social Security has changed, right? Typically, if you were born in certain timetables in the 50s, when you got to the age where you could retire, the old plans were such that you could take your Social Security and you can continue working if you wanted to without a reduction in your Social Security benefit, okay? a lot of that has changed over time. And as more and more of the baby boomer generation is approaching retirement, it's stretching out the age of where you could achieve full benefit. So for example, I will be 60 years old this year. For my date of birth in 1963, you have to attain an age of 67 to achieve your full Social Security benefit. So if I want to say, well, at 62, I'm thinking of retiring, but if I take my Social Security at 62, I have a reduced monthly benefit. What if I consider retiring and taking out a reverse mortgage using the equity in my house to cover the gap between age 62 and 67 until I could take full Social Security benefit and not liquidate that nest egg I've set aside, right? Or maybe it's not a good time to liquidate my nest egg and I use my reverse mortgage, stay in my home, don't make any monthly payments. And then at such time where my nest egg over here has, had a good stock or, valuation, liquidate some at a later point at a high and then pay down that reverse mortgage at that point. Okay, so there's a lot of things you can do here to work with your earnings that might stretch it in a certain way or give you more control over the when of having to take that nest egg down. Okay, just a thought on that. So if you ask yourself, why wouldn't you get a reverse mortgage? Wade Pfau, he's done an extensive amount of research on reverse mortgage and the strategizing of using it. And he's saying, use strategically. A reverse mortgage can greatly improve the sustainability of your retirement income. Okay. So qualifications and options. So who qualifies? As we mentioned, you've got to be 62 or older. You have to be a homeowner because it's based on equity in your primary residence. You have to own the property outright or have significant equity. And we're going to get into those percentages in a little bit. Primary residence and meet minimum credit and income requirements. And it's not the standard way we qualify someone. It's much like a VA loan would be, where we look at a residual method where we assess family size based on geography and family size. There is a minimum amount of residual income or net income from whatever pensions or whatever you receive each month that you have to show you receive in order to meet the qualifications for this loan. So it's not a heavy, you don't have to have perfect credit for it or things like that. It's based on age, it's based on residual income and satisfactory credit. What are the eligible property types? All single family residences, 2 to 4 unit properties, as long as the borrower occupies one of the 4 or 2. Townhomes, condos must be FHA approved. Remember, the underlying product is an FHA product. There are some cases where condo units can be approved for a single unit approval if, for instance, the condominium did not go and attain FHA approval for the full condo. So there are some things we can do on this particular product for a single unit approval. PUDs, planned unit developments, modular homes, and manufactured homes that meet FHA requirements. So how much equity do I need? Okay, roughly 50% of home equity to qualify for a reverse mortgage. Okay, roughly. Sometimes you need more, sometimes you need a little less. But let's say you've got $400,000 as a market value, $100,000 left on the mortgage. There's $300,000 in home equity. Okay. If there was a shortfall in being eligible for a reverse mortgage because you didn't have enough home equity for the new reverse, you can use your personal assets to get that mortgage balance down so you can obtain a reverse mortgage. So how can I take the proceeds, right? You can do a lump sum disbursement of the proceeds. So think of like a home equity line but it's a home equity line with no monthly payments, right? You can take it all at once. You can take it in fixed monthly advances. You can use it as a line of credit, take zero and just use it as you want. Or you could do a combination of the two. So again, I'm going to use a personal example. My father passed away in 2006. I have a mother who's going to be 92 years old next month, who's in absolutely fantastic shape. And we set up a reverse mortgage for her in 2007. And at the time, she wanted to put a new roof on her house. My house that I grew up in New Jersey was built in 1910. So needless to say, there's things that needed to be maintained on the house. But she said, I want to put a new roof on the house. And so I want to disperse a certain amount. And then I want to take a stipend each month to add to my Social Security benefits. So that's what we did, and we're now, past 15 years, and she's still taking that stipend each month, and her home is appreciating, and she still has that as she's aged beyond the passing. So that helped the family and the children in terms of her assistant, and it empowered her to use her asset as she wanted to. Okay. So how much money can I get? So the amount of money you get depends on the age of the youngest borrower in the transaction or the non-borrowing spouse. So sometimes you have a, you have the borrower is 65 years old and the non-borrowing spouse might be 62 years old. The amount of cash is going to be based on the non-borrowing spouse at age 62. The amount you get depends on the interest rate you get on the loan. As rates are higher, you get less. As rates are lower, you get more. It's just like on the forward side when qualifying. The lesser of your home value or the HECM loan limit of $1,089,300. So you've probably heard that FHA has high cost areas across the country. Right? The Washington metro area is a high cost area. So that FHA high balance limit is $1,089,300. On a reverse mortgage, that limit is for every state. There is no high cost or low cost area that impacts the amount of where the reverse mortgage could go. It's $1,089,300 on a reverse. So you don't have to worry about geography here. If you're moving out of state and your retirement home costs $800,000, you know what I mean? There's still a way that you can look at the HECM. So how much money can I get? So here's an example that we'll go through and it'll give you an idea. So hypothetical example, you have the youngest borrower's age is 74. Let's say the expected rate was 5.5%. The home value was 600,000. So PFL, that's really for us, that's called a principal limit factor. It's a factor that's used in determining the amount of where the mortgage can land. So in this case, if you look at the chart, you go down to the age of 74, the interest rate was 5.5. The principal limit factor says we can lend 45.8% of that home value as far as a reverse mortgage goes. Okay, so think about it from the standpoint, if you have somebody selling a home here with big proceeds coming out of it, and they say, I'm going to go retire and I'm going to pay cash for that retirement home, right? Well, maybe this is a better situation. Maybe instead of using $600,000 in all cash to pay for the new home, they do a reverse mortgage, right? And use, everything but the $274,800 they could get in a reverse. They still have no mortgage payments, but they get to keep that 270, roughly 5,000 working for them in another account. Let that earn interest. Let that make and appreciate at a greater rate than what the negative amortization is on this loan. And then maybe at the end of the year, if that account is done really well, take the gain and apply it to the mortgage balance. Do you see the amount of control then that gives you in your own assets? Right? I recognize that your balance is going up, but I tell my children, I'm like, I can do this. And then that house is what I consider my throwaway house. If I decide that I want to retire sooner than later, then any house that I retire into, if I take a reverse mortgage out and I pass away and it has a balance on it, then so be it. The house is going to take care of covering that balance. You don't have to worry about it. And I'm not so concerned with leaving my children the equity in my property. I'm concerned with being healthy and happy in my retirement. So everybody has different reasons for many different things. And trust me, this was a fight with my mom at the time, because she's like, I need something to leave my children. I'm like, your children are between, 57 and 65 years old. We're good. You don't need to worry about it. So this chart gives you an idea. So if you think in your mind, you've got someone maybe aged around 62, figure that the reverse mortgage might be close to about 40% of either the value of the home or the sales price. Okay, just as a general rule. So using it, and I've talked a lot about it, but the unused portion of your line of credit grows. Okay, it grows each year. It grows over time. It appreciates as the house appreciates in value. It grows at the same compounding rate as the loan balance. So just because it's set up at a particular limit today doesn't mean that it's going to stay at that limit as the loan balance grows. It grows, and it's reusable as well. If you pay it down, you can reuse it back up to that new limit. You have greater borrowing capacity over time. It's secure. It can't be capped, frozen, or eliminated due to market conditions. So how many of you have gotten a notice in the mail in the last few years that, sorry, your access to your HELOC is no longer available? Okay. We're not going to allow you to access all of it any longer. We're stopping it here. A lot of my borrowers got that in the last few years, just because market conditions dictated that mortgage companies did not want to take that level of risk, notwithstanding where the values of properties were. Not every area is like this area. Okay. It's liquid home equity. It can be borrowed, paid back, and borrowed again. So it's got a lot of flexibility that way. So, and this is just a visual representation of what we were just talking about, right? So the line of credit versus the home value. Home value 600,000, available line of credit at age 62 was 223,506. Same borrower, age 89. Home value is now over $1 million, and the line of credit available moved to $1,026,000. So you can kind of just see there how that would work. So again, common uses of the HECM. You can refinance a standard mortgage to eliminate monthly mortgage payments. Property charges, again, like taxes and insurance, have to be paid. You can use the available line of credit as standby portfolio protection. And that's really what I see here as key in the financial planning process as you move into retirement. You can enhance your cash flow in economic downtimes, which can make the investments last longer while the net worth doesn't necessarily decrease. So I've got a realtor friend who has a reverse mortgage on their property. And he said to me, Kelly, at the beginning of the year, I never know what I'm going to make. I never know what I'm going to make. The market's crazy. I could have a great year. I could have a poor year. He says, so I go the whole year and I don't make a mortgage payment. And then at the end of the year, I look at my earnings and I earmark what I want to pay toward the mortgage. That might be a large lump sum. That might be zero or somewhere in between. But it gives me the control that I need in terms of how I earn my income, which varies with commission earnings, as to how I use this in my overall planning for my retirement. So even if you're moving into retirement and you're still working, right? You could be still working a bit, and like for us in this industry, it's very hard to get out. It's like I'm in the mob. I can't get out. It keeps pulling me back in because we all love the challenge of it, or we wouldn't be here. But there's so much versatility on this particular program that if you really start thinking about it, it's got a lot of value. You can increase your cash flow to close the retirement income gap, as I was talking about. Get the most lifetime value from your Social Security benefits, enable you to start drawing your Social Security at your highest level age. You can help donate to your family or charitable organizations if you want to do that. Some people do use the reverse to give gifts for college or grandchildren things, weddings, etc. It's a wealth multiplier that you can potentially pass a larger nest egg onto the next generation. Because if you look at your house as taking care of itself, okay, at the time of your demise, then your other investments that you might have held out have continued to grow over that time for you to create that nest egg for your next generation. You can pay for home renovations. You can use it to pay for in-home care, other big ticket expenses, and long-term care insurance premiums as well. So there's a lot of versatility here. And this is a great chart that kind of gives you an idea of home health care, assisted living, and nursing home care comparisons, right? So home health care on average for long-term care is about $59,500 annually. Typically Alzheimer's, meal prep, diet monitoring, housekeeping, errands, or shopping. It's a lot of money, right? Assisted living facilities, $54,000 annually. On-site nursing, private apartments, daily living, help with medications. And then nursing home care, annually private, $108,405. Full-time in-facility care, advanced long-term care, therapy, rehab, medication, 24-hour nursing. It's a lot to plan for. And Medicaid only pays for shared rooms. So 95% of people have no long-term care insurance, and over 50% will need it. So how is a reverse mortgage used for financial planning? Again, you can keep your adjusted gross income low because it's not income. If you distribute from a reverse mortgage, it improves your cash flow, but it is not income. Just like when you pay a mortgage isn't income to anybody else. In the reverse way, you're just using your equity. That's all you're doing. You make your traditional retirement funds last longer. Again, you can use it as a hedge against market risk or a sequence of returns risk, right? And as we've come out of COVID and a lot of different things have hit retirement accounts, this is a stopgap that you can look at for stretching those retirement funds and getting them back up to where they need to be. You can insure against longevity or pay for long-term care and maximize, again, your other retirement contributions. So again, why incorporate home equity into the retirement income strategy? Why 62? Why do this at 62 and not at 82? Why would doing this sooner than later be a better way to secure a reverse mortgage? Well, let's look at the coordinated strategy. So Sachs and Sachs coordinated strategy says, if you open a HECM line of credit early, 78% have cash flow survival rate, meaning you have enough cash to last you through your entire retirement. 4% post-tax initial withdrawal rate based on 32-year investment return, right? So assuming you're going to live to like 94 is what that says. Home equity as a last resort conventional passive strategy. So let's say you delay opening a line of credit until your portfolio is depleted, right? You've deferred the decision for a reverse mortgage. You've used everything in your portfolio. Your cash flow survival rate is now dropped from 78% down to 60% to get you through that next 32 years. And then at a 4% post-tax initial withdrawal rate, you ignore your home equity altogether. You're sitting in that cash cow house that's got all this equity and not working for you. The cash flow survival probability is 35% to get you through to the age of 94. So it's staggering, the difference between it. Again, incorporating strategies into it, that's just a visual representation of everything that we said. Opening early, but delay its use, as long as possible, offered increasing success rates as more of the line of credit was available over time, right? Because that equity line grows over time. And you just don't know when you're going to need it. You don't know what's going to happen. So the HECM has top consumer protections, really have been worked on in the last 10 to 15 years to take a lot of the scare out of this program. The borrowers do have to receive counseling from a HUD-approved agency. We arrange that. There are initial disbursement limits, okay? There are cases where you can't get all of the money right at closing. Sometimes it takes up to 12 months for you to get all of what's available to you. So in some cases, let's say you were eligible for a disbursement of 200,000, but there's something in FHA's guidance that in the first year you could only get X, and then after that 12 months has passed, you have access to the rest of it. Okay, so there is some initial disbursement limitations. We do a financial assessment, as I mentioned, based on residual income. The non-borrowing spouse protections, due and payable status may be deferred. So if you have someone who's a non-borrowing spouse and the primary spouse borrower has passed away, there are some non-borrowing spouse protections that can allow them to remain in the property. Line of credit is secure. An unused line of credit grows regardless of the home value. It does grow at a percentage each year regardless. And again, that non-recourse feature, meaning you're never going to owe more than what the property is worth on the house. Okay, it's not like they're going to come take it from you. Can a reverse mortgage be used to buy a home? Yes, this is our H4P program. It's the HECM mortgage for purchase, right? This is what we were talking about. You can upsize, downsize, or right size to your ideal home. You can move closer to your grandchildren. You can put as little as 45 to 65% of the purchase price down from your funds, keep more of your retirement assets, as we discussed. And then again, no required monthly mortgage principal and interest payments, just the taxes and insurance. Now, there are other reverse mortgages called proprietary mortgages. These are more conventional based. There are individual investors out there that are typically set up to do reverse mortgages when you have properties in excess of that FHA limit of that $1,089,300. So there are some proprietary, places out there. Maybe it's a non-approved FHA condo complex. Maybe it's a reverse mortgage where the investor has decided they're going to offer them at age 55. So there are some proprietary ones out there. We offer the HECM. There aren't that many proprietary ones that we have access to, but we do have a couple. And they want to avoid the mortgage insurance monthly on the FHA. So loan maturity, what causes that mortgage to become due and payable? So this is always the biggest concern. Okay, someone's going to take my house. Well, no, if you sell your home, you've got to pay the mortgage off, just like any other mortgage. Okay, sell the home, you got to pay the mortgage off. If you transfer the title to somebody else, it's due and payable. You've got to pay the mortgage off. The last surviving borrower moves out of the home permanently. Okay. You can have people that are snowbirds. They have their primary residence, they have a retirement account, but they go and they stay with their sister or brother in a warm climate during the winter. That's not moving out of the house permanently. Okay. If you default on the loan terms, you fail to pay your taxes and insurance on the house, they could be due and payable. And the last surviving borrower passes away. So how is the loan balance repaid? Okay. The loan is not yet due and payable. The borrower can pay as much or as little on the loan balance each month as they wish, or they can make no monthly payments at all other than the taxes and insurance. Now, let's say one of those prior events happens that we just mentioned. Well, then the loan is due and payable. It's typically satisfied via the sale of the home. They are non-recourse loans, meaning the sale of the home will always satisfy the loan repayment obligation. Neither the borrower nor the heirs will be personally liable for any balance deficiency. So let me repeat that. Let's say we have a property whose value at the time of sale is $400,000, but whose loan balance is $425,000. Okay. That $25,000 is not paid by the heirs of that property. It is not owed. That is what the mortgage insurance covers. Okay. So there's no one coming after anybody for that deficiency in the payback of the loan. Okay. Really powerful. The options for the heirs, right? Look at the grid. Do the heirs want to keep the home? Is there equity left? So in the first quadrant, top left, yes, there's equity left, and the heirs want to keep the home. Well, they could pay off the loan or refinance the loan balance out of a reverse mortgage into a forward mortgage, right? If they're not eligible for a new reverse in their own name and they're not living there, okay? If there's no equity left in the house, but the heirs still want it, they don't want to sell it, they want to hang on to it, well, they can buy the home with a short payoff of 95% of the appraised value. So in the prior example, if the house appraised at $400,000 and they owed $425,000, but the house appraised at $400,000, the heirs can buy the house for $380,000. 95%, $400,000. Okay. And the bottom left, the heirs want to keep the home. Yes, there's equity left. They can sell the home and pocket any of the profits. Okay. And then no, there's no equity, and no, they don't want to keep the home. They could sign the house away in a deed in lieu of foreclosure and walk away. So if they don't want to market the home, right? There's no equity in the home to sell it. I've inherited my mother's home. It owes more than it's worth. I don't want it. I can just say, you know what, I'll sign it over in deed in lieu and walk away. It has no bearing on my credit. It has no bearing on anything. I can walk away from it at that point. So lots of options here. Again, why Fairway? We're just a full service lender. We do a ton of HECM and reverse mortgages across the country. I am really passionate about this program. I think there's a lot of misinformation out there about it. I really try to serve and educate people about the advantages of it. Many of us have just become certified in reverse lending as a result, because there's just much like the millennial population moving into home ownership at the age 32, between 31 and 33 as an average, you're seeing this huge population of the baby boomer generation move into downsizing and really concerned about outliving their savings, truly concerned about outliving it. And I just think this is a great way to perhaps address that. A little bit about Fairway. And then I just move into questions, and we had a quiet group today. So let's unmute. If anybody has any questions, I'm happy to answer them. I really appreciate everybody's time today. So, anybody have anything?
I have a question about you were talking about the ages of the borrower and then the spouse of a borrower or the
Mhm.
surviving borrower. Yeah.
Mhm.
What were you saying that about the age gap? I didn't catch
Yeah.
that.
So the calculation of the amount of the mortgage is
Mm.
calculated on the youngest borrower in the property. Okay, so even though like you might do the loan in the borrowing spouse, let's say I did it in my name
Mhm.
and I was age 65, but my spouse was aged 63. The
Mhm.
amount of the proceeds would be calculated on age 63.
Okay.
You
Gotcha.
get more the older you are. Let's put it that way.
Okay.
You get more the older you are.
Got it. Thanks.
Mhm.
So, say if one spouse is much younger, say the one is over 62, the other one is only 42. Can they
Mhm.
qualify for this kind of program?
Yeah, it would just be done in the age 62. It would just be done in that person's name. Like you might still be on title. They might look at the non-borrowing spouse in terms of income and or household income to meet residual earnings, but it's going to be based on the borrowing spouse's. It's going to be based on that borrowing spouse's age, that one person in there. You can't tell somebody age 62 you can't do it. What you can do is talk to them about, okay, well, what's the max they can take out based on that situation?
Got it. And also you mentioned that it's a non-recourse loan. Okay,
Mhm.
so say if the owner fails to do the upkeep or maintenance of the house, and the house, the value of goods gets really low when the person passes away, what's gonna happen? It's
Again, it's like any other house, right? It's like any other house. What's the value? There isn't someone coming out and doing a spot check to say, hey, did you replace your roof this year? Okay.
Mhm.
It's like any other house that needs deferred maintenance. What is the market value of that house and how does it relate to the balance owed? Okay, so if you can't sell the house, right? And it's, if you're asking me if they've passed away and now here we sit, right? That the value of the house, let's say, is 500,000 and they owe 550. Well, the heirs might say, you know what, the bank can take it.
Mhm.
I'm just going to deed it over in lieu of foreclosure and here you go. And they will take it and they'll fix it up and they'll sell it and they'll do whatever they want to do with it. But if the heirs want it, then they can apply for, they can buy it at that point for 95% of the appraised value. And that gap is paid by the FHA mortgage insurance fund.
Okay, so they,
the
okay,
lender.
there's an insurance.
Yeah, because in the
Relations.
monthly payment, okay, in the negatively amortizing monthly payment, there's mortgage insurance every month that's getting added to the monthly balance.
I see.
Okay, and that's why people say, well, oh, reverse mortgages are so expensive. Well, compare it to what? What other mortgage product out there would allow you to access the equity in your home and have no monthly payments and cover a value gap in the event you need to sell the property at a later point without recourse to the heirs? There's nothing like this product. So from my perspective, take the cost of the product out of the equation. There's nothing out there like this that allows you the versatility and the benefit to the heirs at the time, you know, they need to vacate the property. If it was a forward mortgage and the heirs wanted it, right? It wasn't a reverse mortgage and you had the same scenario. They owed 550 on the house. They passed away, right? They left it to the heirs. And now the heirs are like, oh my God, this loan has to go, you know, it's coming to us. We have negative equity in the property. What do we do? Well, you know, they're not going to want it either. It's the same situation. They're going to, you know, let it go back to the bank because they don't want to come up with the 50,000 that they need to clear it. This particular loan gives the heirs an opportunity to purchase it at 95% of that appraised value, even though 550,000 is owed, they can buy it for 95% of 500 if that's where it appraised for. You couldn't do that on the forward side.
I see. Thank
Yeah.
you.
Mhm. Any other questions? Did
Hello,
everybody learn something today?
yes, definitely. Could you explain how the negative amortization happens?
Sure.
I cover-
So when you think about how you make your current mortgage payment and how little principal you pay each month, okay? The HECA mortgage works like a home equity line of credit where you have an index and a margin, just like each month, like on your credit card, right? You have a variable interest rate attached to the Wall Street Journal prime rate, right? So you might
Right.
have prime plus a margin, and that varies each month.
Correct.
Okay, it just varies in reverse. So each month you have a monthly payment due based on that prime plus index equals the rate calculated on the balance. Here's the principal and interest payment, right? Over that 30 years or remaining months. Okay, you have a 30-year note. It's month, 359. It's month 358, right? You're calculating it out. And you have a mortgage insurance component. Okay, that's added in
Okay.
that payment, just like on the forward side, only it's getting added to the balance. It's getting added to the balance. Now, if at the
Okay.
end of the year you do a lump sum payment, right? You're going to
Right.
apply it to it'll go toward, mortgage insurance due, it'll go toward principal balance. And the next month following that principal reduction, you would have a recalculation off of the remaining balance at that time. But
I see.
again, as prime goes up and down, that payment's going to go up and down in a negatively amortizing way.
Okay, I see. So it's never consistent. It's directly connected with the index and the prime.
Correct.
Got you. And
Correct.
so insurance and everything is paid on top of
Annually.
annually.
Right.
Got
Yeah,
it.
so twice a year or once a year, just like if you had a mortgage with no escrows, right? You would be paying
Right.
them yourself out of your own account.
Right. Okay. Very nice. Very nice.
Mhm.
So-
Thank you.
The rates really has nothing to do with this borrower's credit, right? It's not like our traditional mortgage.
No,
Okay, just
No.
always, how about the insurance?
no. Well, I mean, insurance is always a function of their history, just like auto insurance, right? What does your history look like? You're going to get homeowners insurance on this, just like anything else. The mortgage insurance
Yeah,
is the
mortgage
same rate for
insurance.
everybody. Same
Mhm.
rate for everybody. It's a 0.5% on a monthly basis.
Okay,
It's the same for everybody. And then
So
you have a
say-
financed amount. It has a financed amount of 2%. And it has a monthly amount of 0.50%.
so can you give us an example of one case that you're currently work on? Give us an idea of the rates, like the monthly payment, the interest rate, the insurance, mortgage insurance. Give it so I can have a rough idea how much payment
Yeah,
we're looking at.
I can't pull rates right now. But you're probably like, if you're, so think about it, like the prime rate currently is running around 7.25%. The margin is the margins are what calculates the distribution. So you could have this loan, the most common margin on this loan is 2.5. So if you took 7.25 as the index, right? And you added 2.5, you'd be at 9.75. Okay.
Plus,
Right now,
Yes.
let's say prime rate starts coming down. What always is going to stay in place is that 2.5 margin.
yes.
But as it comes down, just like on your credit card, just like on your home equity loan, you're going to calculate principal and interest off of the rate that month on the balance that month. So if
Got
you
it.
then throw 5,000 against the balance, it's going to be recalculated the next month on a lower monthly balance.
Got
Make
it.
sense?
Mhm.
Yeah. And then the mortgage insurance is calculated on the remaining balance at 0.5%. So you could take the loan amount times 0.50%, and that's your monthly mortgage insurance.
Okay. So it's pretty easy,
Yeah, it's not difficult.
pretty
It's just,
straightforward.
it really is a mindset. Like my mother would say to me, oh my God, I'm looking at my mortgage statement. And I'd say, don't even open the envelope. What does it matter? It's not a problem you have to worry about. What do you care how it's moving every month? You're not going to take your savings and pay it. So just don't even open it. It doesn't matter. You know what I mean? Like it's a mindset thing. I think at my age, it's a financial strategy thing. It's like saying, okay, what do I want my retirement to look like? How do I want to use the asset that I've created over time to stretch my retirement earnings or possibly retire earlier than I thought I would? And use it as a stopgap till the point where I can take full Social Security and really start maximizing my distributions from my nest egg. So to me, it's a vehicle. And I think if you have a financial planner, I'd love to speak with them because they don't understand how this can be incorporated into overall financial planning strategy in terms of keeping money where it should be while it's making the most it can possibly make for you. And then strategizing when to take those gains and perhaps move it to this mortgage product or to leave it where they are.
And how long can this stay open? Is there a time limit?
Yeah, well, normally they calculate everything out to age 100 is how they calculate it out to. So a lot of the, actuarial tables are done to that age as a limit. Yeah. Anybody else?
Well, they don't kick them out at age 100.
They don't kick them out.
No, they're protected. And that's why it's such a good strategy, because if you think about it, a lot of people really don't have enough money to retire. So I had to really get my head wrapped around this because I'm an investment minded person. And I had to educate my financial advisor, but she thinks it's a wonderful strategy. Like she said, Cindy, how many houses are you going to leave your kids? Right. That's exactly right. So why not give yourself, and you don't know about investments. They're up and down. I've got a lot of conservative ones. Houses, who knows if the value is going to stay where it is? I mean, you don't know. You have all these variables. You need to have a solid nest egg where you don't have variables on at least some of the money.
Cheryl, I will check on that. Normally they look at both spouses to be within that age, but I know we had that question earlier. What happens if a spouse is 42? What happens if a spouse is 54? Let me get a little bit more clarity surrounding that issue and I can get back to you on it. Just put your email in the chat and I'll double check it. Because I don't want to say something. In a lot of cases, there's clarification between a non-borrowing spouse, but what happens if the spouse is or is not on title? And that's the piece I just want to double check is in your case, if the unemployed spouse is 62, right? And you have a working spouse who's 54, but let's say that working spouse is not on title. That's what I want to ask the question. Could they do it if the working spouse is 54 and not on title? Or if you have someone age 62 and the spouse is 54, but they both want to go on title. So let me just get clarity on that to be 100% sure. And just go ahead and put your email in the chat.
Yeah, we're not going to keep the chat for long. So why don't I'm sending you the roster.
Okay.
Yeah, I'll just copy and paste this and send it to you because once this is gone, it's gone.
Yeah. And I've written down the email. That's fine. And that's Cheryl, right?
Yeah.
Okay, perfect.
Yeah, I'm going to make sure you have it.
I'll double check it. 62 is the unemployed spouse and 54 is the working spouse. Okay,
Yeah.
Let me get clarity on that.
Yeah, but use Katalinas as a resource, guys. I'm going to put this in the member site. So this presentation, once I process it by tomorrow morning, it'll be under Real Estate 101, which will be on the member site. You get to it by clicking on the banner at the top of cindybishopworldwide.com to upcoming events. All right. Thanks,
Mhm.
Kelly.
All right, thank you, everybody. I really appreciate your time today.
All
Thank
righty.
you so much.
Thank
You're welcome.
you.
Have a great day.
Bye-bye.
Bye-bye.
Bye.